lineup of ETF experts today, so let's get started. With us is Armando Senra, head of iShares Americas at BlackRock. Jay Jacobs is the head of research and strategy at Global X ETFs. Ed Rosenberg is the head of ETFs at American Century. These are the experts in the whole business. Armando, you run iShares. This is the largest ETF family out there. You've been seeing strong interest in factor investing, investing based on quality, on value, on momentum. Why are we seeing such interest in factors?
Today, we will discuss a highly effective strategy that has become popular among financial professionals. Factor investing. In the 2022 annual Invesco Global Factor Investing Study, around 2/3 of investors said factor investing helped them manage market volatility over the past year. A similar number indicated their confidence in factors grew over the previous 12 months. More and more financial professionals are adding this strategy to their portfolios because of its track record of outperforming the market. It's important that you become familiar with it. Factor investing is an investment strategy targeting specific drivers of returns, known as factors. These factors, such as size, value, momentum, quality, and volatility, are characteristics of securities that have historically demonstrated excess market return. By focusing on these factors, investors can identify and take advantage of systematic patterns in stock returns. Factor investing isn't new. It dates back to the 1960s. It started with the capital asset pricing model, which identified market risk as the primary factor explaining stock returns. The theory evolved with the Frama French three-factor model, which added size and value to market risk. The most commonly used factors in investing include size, comparing small versus large companies; value, analyzing cheap versus expensive stocks; momentum, identifying trending versus non-trending stocks; quality, assessing profitable versus unprofitable companies; volatility, comparing low versus high volatility companies. How does this differ from picking stocks the old-fashioned way? Well, rather than focusing on an individual company's prospects or the broader market movement, factor investing targets persistent, long-term drivers of returns across industries and securities, which can improve portfolio performance and risk management. So you're convinced of adding factor investing strategy to your toolbox, but how do you implement it? The simple answer is through factor-based funds, although you can gain exposure to these factors through individual stocks. Investors who want a slice of the factor investing action without going all in on individual stocks commonly use factor-based ETFs. Factor investing is a strategy used mainly by professional money managers, and for good reasons. It's about focusing on systematic patterns to navigate market storms, minimize risk, and increase returns. Before you jump into purchasing factor-based ETF, pause for a moment. Imagine factor-based ETF as ingredients in a recipe. Before adding them, you must know how the macroeconomic market regime affects how tasty your investment dish will turn out. Don't miss our next video series on macroeconomic regimes, where we will go into detail about how these market regimes can make or break your factor investing strategy. Have questions or want to share your experience with factor investing? Leave a comment below, and don't forget to like, share, and subscribe. See you next week.